Welcome everyone to the start of a new series. This is just quick company overviews, and the first one is Assura. It was actually suggested in the comments section a few days ago. Ticker symbol AGR. We're going to look at what they do, their dividend yield, and all the financials we can squeeze out of simply Wall Street. Right. First off, their price, 52 pence at the moment, market cap 1.5 billion, and a dividend yield of around 6%. But you've seen that from the thumbnail, so let's get right into the nitty gritty. They're down 23.4% year to date, trading at about closer to 71 pence in June of last year, and now they're down at 53. They're a member of the FTSE 250, and they are a 6-star dividend payer, which is a very rare sight, up there with the likes of Legal & General in terms of the analytics that simply Wall Street use to give their 6 out of 6. So we'll be looking deeper into that. Who are they is a really good starting point. UK REIT, Real Estate Investment Trust. They're a long-term investor and developer of primary care property. Think GPs and care homes and the like. Their financial health, that's alright, as well as valuation. Future growth seems to be pretty good as far as the analysts think. And then their past performance, it's not the best either, but we'll be looking into that. So, first things first, just a few footnotes. Their earnings are forecast to grow 48%. Their dividends high and reliable at 6.03%, and priced earnings is 13.1 times, which is actually below the UK market. Now, here's some risks. Their debt isn't well covered by operating cash flow, but they are a REIT, so you have to factor that in. And large one-off items impact financial results. It seems that that's quite usual across the board. Competitors, primary health properties, Impact Healthcare, London Metric. I would say the first two are definitely as close as you get the competitors in this space. They've actually a slightly higher market cap than PHP. Fancy that. Their price history performance. Now, we have seen them within the last year, but I always like to pull the chart out 5 years, get a wee bit of an idea, especially, how did they react over COVID? Obviously, a lot of stocks plummeted, but how far down are they? They're actually lower than they were back in March of 2020. They were trading about 65 pence, so they're even lower than that. And then if you bring it back in, you can see that it divides it out quite nicely in Simply Wall Street. Dividends are all the wee green dots, financials, and then by clicking into them, give us a wee bit more information. Pretty neat. In terms of recent news, less of half directors are independent. Their earnings released. EPS was about half of that back in the first half of 2022. Not great, but they did declare their dividend. So we'll be looking more into that. Shareholder returns. Let's see. Over the last 6 days, they're up about 6%, as well as it seems that healthcare REITs are making a wee bit of a rally at the moment. The entire Great Britain market, not so much. But you can see healthcare REITs were hit pretty hard in the last 12 months. Obviously, with all the inflation, economic woes, it doesn't bode too well to a lot of these REITs that have a lot of loans out for properties, and interest rates and whatnot really affect their performance. And that is reflected in, of course, their share price. Now, they've 87 employees. Their CEO is Jonathan Murphy. There we go. Don't know why I had a struggle there, but it is what it is. We can see again, long-term investor and developer of primary care properties. That means they work with GPs, health professionals, and the NHS. Now, it's always good to see that, especially when you're looking into a company, because any that are quite cozy with government in that sense tend to be, and this isn't financial advice, this is pure speculation, and they tend to be a little bit safer on their income streams, because obviously the NHS and the government have quite a lot to spend. A lot more so than the private industry in some instances. 30th of September, the property portfolio was valued at 2.25 billion. That's what 2,259 million pounds means. So pay ratio 13.1. That's not the worst. We'll have to see how it compares to other companies. A pay ratio on its own, some people can look at that, or the price That's the price to the share ratio, or price to sales ratio. Some people are going to look at that and instantly, have a good idea of the company overall. But it's a metric that is usually better when it's compared to the likes of PHP and their other competitors, which Simply Wall Street will do later on down the page. Earnings and revenue, 146 million in revenue, 11 million in cost of revenue, massive amount of growth profit, which means, obviously, as a REIT, about 95% of profits are to be returned to shareholders. Profit margin or gross margin 92%, net profit 80%, debt equity is about 69.9%. Their payout ratio is 87%. As I said, REITs are about 90% payout ratios normally, and yield of 6%, which is pretty high. In this current economic environment, that is pretty high. Now, let's start comparing them with their peers. So when it comes to against PHP and Impact Healthcare, they are half when it comes to price to earnings ratio, which is actually really impressive. I didn't realize they were that much better off than these two. Now, it's not everything, but it's definitely something to look at. Industry average for global healthcare REITs is 24, and they are actually trading at 13 times, which is, again, nearly half. So, by that metric, pretty good. Now, are they a fair PE? Now, this is based on a model. Fair PE for them is 12.9, and they're currently at 13.1. That's not the worst. But when it comes to a discounted cash flow model, sometimes it can be very punishing for REITs. In this case, it's actually overvalued at 53.5%. Now, as you've seen, they haven't actually seen their fair value price of 34 pence, and a lot models like this are definitely up for debate. Never take them at face value. This stock may never see 34 pence per share. It might, but it might not. And it could hover around this and go higher, certainly. So when you're looking at this metric, always compare it to something like intrinsic value or any other model. It is just a model. That's what it's based on, future cash flows. And again, depending on analysts and the economy and many other factors, it mightn't be correct, especially on REITs. It sometimes hits the nail on the head for a lot of other stocks, but just be careful with that one. Now, when it comes to the analyst targets, because I love hearing what analysts have to say, in the next 12 months, it reckons they'll recover by 24%, it seems, and they're in good agreement. Again, analysts, so you've always, no one can correctly predict the stock market, so it's definitely up for debate in that one. But we'll move on. Future growth. Currently, they score 4 out of 6 on this, so quite good. Key information, earning growth rate is at 48%, and earnings per share is 58.9. Healthcare REITs they seem to all be at least predicted to grow in the next few years. We'll see. We can see that they're projected to have quite a dip in earnings. I'm not entirely sure why that's the case. That could maybe be a little fumble in the data, certainly, or it could be reflecting the economic times. That's why having a bit of a deeper dive into something like that is certainly worthwhile. Their free cash flow also being down. Now, it is an analyst forecast. That's why I'm a little dubious in that one. But anyway, we'll continue on down. Future return on equity forecast to be about 5.5% in the next 3 years. It's not wee bit higher than industry average, 5.2. Now, past performance, you get more mileage out of this one. They do score only 1 out of 6. Earnings trend seems to be the only thing going well for them. But again, we'll have a wee look. So, June 2016, they were, the revenue of 63.5 million, earnings 31.15. Now, as you can see, earnings has been up and down, but revenue has consistently climbed from 2016. They've now almost doubled their revenue per year, quite impressively. Operating expenses, again, haven't really increased all that much. Now, we haven't seen into 2023. This chart could change quite a bit. You've seen the forecast that it does seem to be a bit more on the negative side of things. So we'll have to keep an eye out for that one as well. Okay, let's carry on to financial health. So 2 out of 6. Let's see how we're doing. 190 million in short-term assets to 65 million in short-term liabilities. Gets a lot better in the long term though. 2.9 billion in assets to 1.26 in long-term liabilities. That's a sort of chart you'd see closer to a mining firm in a lot of cases. So we'll see how the debt to equity ratio, 1.7 billion in equity to 1.2 billion in debt. Cash and equivalents, we'll throw that in of about 159 million. Okay. I mean, at least their equity has definitely been outpacing their debt, but again, we'll have to see how 2023. This is one of the ones that I'm going to keep an eye on, especially leading into the latter half of the year. Let's say debt coverage is not well covered at 7.4%, but it is covered. That is a crucial point to make. Interest payments, though, are well covered by earnings before interest and tax of 4.3 times coverage. A wee bit of a makeup of their balance sheet. Not REITs, it seems to be a lot more vague. It's just like long-term assets, 2.9 billion. But you can imagine a lot of them will be, of course, their properties. When it comes to dividend, though, 6 out of 6. Trailblazing. Pay ratio 87%, but a yield of 6. It is actually forecast to continue growing. You can see that they have been consistently growing their dividend for at least the last 10 years. COVID didn't seem to shake it all that much. Some companies ceased or stopped paying, but it appears they pushed through and continued to increase their dividend per share, which is the turquoise line. I'll remove the yield if it makes it a wee bit clearer. I always love to see that. Yield up and down, obviously due to the share price. The yield being so high right now is because it is down nearly 24% in the last year. Earnings per share is a wee bit more all over the place, but it is forecast to continue to grow as well. A stable dividend for the last 10 years and a growing dividend for the last decade. Brilliant to see. Industry average is actually a bit higher at 6.6%, but they are forecast to continue growing in the next 3 years, and they are in the top 25% of the market. Okay, earnings payout, 87, cash flow, well, yep, expected from a REIT. Management, 4 out of 4. Oh, they're actually ticking off the criteria for management. This is something I must look into. Okay, so Jonathan Murphy, got it right that time, 1.1 million in total compensation. Not a bad pay package. He's got CEO ownership of barely 0.1% of the company. He's been in the position 6.5 years, and CEO salary percentage, I haven't seen this before. They've recently updated Simply Wall Street. So the total compensation allocated towards the salary paid regardless of company performance. All right, okay. Management tenure, board average tenure is about 3 years and 4 years. So it's a pretty experienced board all around. You sort of look for 3 years and above for both usually. We can see his company earnings. They've continued to climb under him. It is forecast again to decline into 2023, but again, it's always something to wait. I don't like to count my chickens before they hatch, so we'll see what happens in the next earning call. Okay, so my favorite part to scroll down to. Ownership. Who some board members bought 9 to 12 months ago. Not much else. Ownership breakdown. Look at this. A whopping 92.1% is owned by institutions. General public second at 7.4%. And a state or government at 0.2%. I wonder will they actually show me who that is. Is it like her HM Treasury? Might be. Okay. So the top 25% own 71%. That's a pretty whopping number. BlackRock and Vanguard own a combined 13%. Wow. Resolution Capital Limited. Okay, that's new. I haven't really seen them before. Production issues. Don't know what happened there. Just decided to turn itself off. Bit of a weather warning here as well. So all good things. Investec, Schroeder, we see Aberdeen, and Legal and General Investment Management also make an appearance. At 0.2%, does it tell me? No, it's not going to tell me. I wonder what state or government has 6.8 million shares in this company. Must have a wee look. If anyone knows, drop it in the comments section. I'll pin it. That would be cool. Just to know. I love wee random facts like that about a company. Employees 87. They had 46 back in 2017, so doubled the workforce. Website available. 2.96 billion outstanding shares. So yeah, it's been a very interesting company to look through. They're traded, as you can see, on the London Stock Exchange and the German one as 75A. And I'm not too familiar with who that is. But yes, that is everything. Oh, earnings. Oh, when it was last put in. Nice. But yes, that has been our company overview of Assura, a real estate investment trust. We REIT. Let me know what you think in the comments of this sort of shorter form content. I said shorter form and I still took quite a while, but I'm just wanting to go through every company on Simply Wall Street. I love the platform and the way everything's laid out, and I think it is really, really easy to follow. I was reading a lot of the comments and I just wanted to try this out. So let me know what you think in the comments section. Thank you for joining me. And by the way, if you are looking at an account in Simply Wall Street, the first 100 to sign up through my link get 40% off. So if you're interested, it's there. And other than that, I'll see you all in the next one. Thank you.